Over the past decade, the stock market has received all the attention and praise from investors, and with good reason. Over the past decade, the stock market has been one of the biggest wealth creators and one of the biggest benefactors of loose and accommodative monetary policy of central bankers and governments across the globe as they worked vigorously to fight deflation. Now, these central banks and governments are faced with a new threat, the threat of inflation. And this is a game changer for central banks, for monetary policy, market cycles, and more importantly, for the way investors may need to diversify and allocate their investments to continue to build wealth over the next handful of years. With these seismic shifts, savvy investors are starting to ask, what are my alternatives? And what if the stock and bond markets go into periods of stagnation like they did in the 70s or even the lost decade in the 2000s? Where else can I consider investing to get income and growth if I'm retired? Welcome to Quiver Financial's Investors Know Your Alternatives. I'm Colby McFadden, and I'm joined with Justin Singletary, Patrick Morehead. Gentlemen, as you know, the past year there's been incredible changes, big shifts. Decades-long changes happening. We had a decade-long bull market. Things seem to be shifting. We got all this inflation going on, worries of reflation. We got all this inflation going on, worries of recession. And it's like the genie's out of the bottle. Like the central banks worked so hard for so long to create inflation, and now, boom, we've got it. And now they feel like it's out of control, right? That's what you're reading. That's what you're seeing. We're getting all kinds of questions about, in this landscape, what do I do? Because the last time I checked the history books, things like inflation and recessions, they usually aren't very kind to investors. And if we gauge that by the stock and the bond market, which is what everybody's invested in, right? Like what have people done the last 10 years? They've piled into stocks and bonds. And if that's how you judge whether it's a bear market or bull market, what do you do now? If stocks and bonds aren't the wealth creator, potentially not the wealth creator of the future like they were in the past, what are the alternatives that we as investors have if we want to create income, if we want to see growth in our portfolios? So let's first start by talking about what an alternative investment is, give people some examples so they have just a high-level view of what we're talking about.
Yeah, and you say that, check in the history books. Back in the day, alternatives weren't alternatives. They were the norm. It was stocks and bonds that were really the alternatives. As the stock market started generating and everything, they were really, for the wealthy and in that type of regards. Nowadays, put it simply, an alternative is an investment that puts money in the investor's pocket rather than in Wall Street's pocket. And that's why Wall Street kind of bashes them, because they don't get any of that revenue. They don't get any of that, profit, income, or things like that. So it's any type of investment that is not correlated to the stock market. We kind of alluded to it. It's real estate, it's doing loans, it's businesses, like private equity and things like that are pretty common in the alternative space.
Yeah, so basically in the alternative space, you have anything from private equity. People consider real estate an alternative.
Yeah. Mortgage lending, becoming the bank type of deal.
Yeah, venture capital, another one.
Venture capital, okay.
Yep.
And so what you're talking about, Patrick, is basically just that there's the main focus of an alternative is the lack of correlation to the stock market's ups and downs or the bond market's.
Well,
ups
that's
and downs,
how mainly that Wall Street identifies it. Yeah, sure. That it's not tied to the stock market. So if in this bear market when everything's going down in the stock market and Wall Street's crashing, typically the alternative investments are going to keep performing. They're not going to have the effect if it trickles down into the economy, then that's where it's going to have an effect. But if the stock market fluctuates, your alternatives won't fluctuate with it. They're going to have their own little sector industry fluctuations.
Got it. You mean like the price of the investment is
yeah.
going to be more stable as there's greater volatility in things like the stock market,
right.
Things of that nature.
Yep.
Okay.
Although with way inflation is particularly real estate investments, might be a little bit getting some of that impact.
Sure. I mean, I'd imagine like all investments, you still have to do your due diligence and be smart and tactical and strategic in the sense that there's times, a lot of people consider gold or metals, right? A commodities, an alternative. And there's times to own that and not. And that's the number one factor that investors always have to consider is that when they hear people talking about things is, okay, is it the right cycle? Because as you mentioned, Patrick, earlier, alternatives was what people used to always do. Like in the 70s, that was the only way of investing because it was hard to get access. Stocks for the rich people. Right, and now that seems to have flipped, where stocks and bonds are for the everyday average Joes, and now these alternatives are for the rich people. Yeah. So I mean, outside of the correlation factor, how can an alternative help in an investment portfolio? Like how can it be used inside of an investment portfolio in times of inflation or recession if somebody's trying to create income or growth?
So reduced correlation, biggest one, like you'd mentioned. So you don't have that direct tie. The only problem is it's illiquid. But yeah, you can create cash flow, get more market depth and breadth with to a portfolio's diversification. And sometimes the returns can be substantial in a certain period of time or window of time.
If you nail the right one,
yeah.
Like everything. I mean, it's the what if game, right? But go ahead. Patrick.
Well, typically they have tax benefits, associated to them, especially the real estate side and stuff like that. And as we talked about at the top about inflation, real assets typically keep up with inflation, so they're an inflation hedge. To whereas the stock market is getting hammered with inflation and things like that.
Yeah, I mean, like I've always been concerned, like with some of the alternatives, because sometimes there's such big minimums. Like you have to have that is really just for the uber wealthy and the rich. So are there ways that you can invest so that way you don't have to put big chunks of money? Can you build a small portfolio of alternatives? Let's say you have $100,000. Can you build a portfolio of alternatives of $10,000 chunks of different things like that?
And we do that for clients kind of all the time. It's because we're trying to open it up to the masses type of deal and diversification, so spreading that money out.
So that's what somebody could do within their portfolios. Essentially, if they're looking at their bond portfolio that they're trying to generate income from, they could look at the alternative space and say, okay, what's an alternative? What's a piece of real estate? What's a lending portfolio or a group of loans or something like that can create income at a time that I need income when maybe the interest rates are rising and my bond portfolio is taking on water.
Well, and you talk about income, and that's why we like alternatives so much, because as you get closer to retirement and in retirement, you have to supplement your income, right? You're now on a fixed income, they say. Well, the bond market during this time period is not going to benefit you for that. So, and the stocks, sure, you can invest in dividend-paying stocks, but the problem with that is if you have a $10 stock and it pays a 20-cent dividend, well, now your stock price on the dividend date drops down to $9.80. So you have loss in value in price, and sure, it should come back, through accretion and stuff like that, but you don't know that that's going to happen. And whereas with the alternatives, it's paying cash flow, supplementing your income, and that cash flow is coming from the operation of whatever that strategy is. It's not coming from the price. So cash flow is a huge key in the alternatives to try and help you supplement your income.
Yeah. Because essentially you're a partner in that business,
right,
and you're getting some of the cash flow off of it
from whatever the operation is.
Yeah, so it sounds like an investor can basically diversify their portfolio in ways that aren't correlated to the public markets. Because one thing I learned in 2000, also in 2008, and both those bear markets in recessionary times, is that when you go into a bear market, everything in the public markets, which is traded on an exchange, they all correlate. I mean, everything basically goes down except for maybe the dollar.
All boats on the ocean.
Yeah, when the tide goes out, all boats go lower. And so that's where allocating some things to alternatives that aren't tied to that public market liquidity factor comes in handy. So, okay.
Well, and it's not just you got to have alternatives or you got to have stocks and bonds. Like every investor is going to have a different allocation, different amount.
That's
this
a great
is just
point.
a portion of your portfolio to kind of help, diversify away from some of that volatility when you get into retirement or close to retirement.
Sure. Yeah. It's not either or. It's
Right.
This is one of the tools within your quiver of tools that you have. So now here, which brings up that point is one of the reasons you don't put all your eggs in one basket is what are the risks? Like Justin, you mentioned earlier, the illiquid. Some people listening to this may not know what illiquid means. So tell me the risks of alternatives and what are the things people would need to think about as far as, okay, what's the downsides?
You want to tell them what illiquid is, and I'll tell you why I think that's still an advantage.
Okay. So illiquid investments are things that you cannot go and sell immediately. Like, for instance, if you go and buy Apple today, you can go and sell Apple tomorrow and get your money back depending on the price. Could be the same, could be more, could be less. When you invest in an alternative, your money is tied up for the time frame that the investment has. So they'll give you a parameter or a set time frame. It could be 5 years, could be 7 years. And that's when they look to liquidate the fund and then give you your money back or your principal amount with probably some sort of boosters or upside if they have those.
Got it. So it's kind of like if you go into an alternative investment that's investing into real estate and, it's like if you called the owner up of that house and said, give me the money, they'd have to sell the house. Yep. So you're basically waiting for that asset to get liquidated before you can get your money back as the investor. So you have to make sure that money that goes into something that would be an illiquid alternative is money that you don't need to use in that particular time frame. Yeah. Got it.
And why I feel that the illiquidity aspect is an advantage is taking an investor's emotions out of investing is one of the hardest jobs that we have. And if you have a stock that is plummeting, they can call you up and be like, sell that stock, even though we think that's probably not a good decision. Whereas these, I want to sell this, the market is crashing. Okay, great, but this investment's not crashing. And even if the price fluctuates, you can't sell it. So it removes that emotion aspect of it, which allows the investment to perform the way it's supposed to.
Forces sticky hands.
Right. And you talked about risk. Risk is very specific to the investor. And so I feel that the stock market is riskier than alternatives. Justin might, have a different opinion. So it's got to be very tied to the investor, what they feel is risky. So I don't think they're any more risky, in my opinion, than stocks or bonds or anything like that. I feel like they're actually more risk averse to volatility and all that type of stuff. So it becomes very specific.
Sure. Yeah. I mean, it's everybody's risk is different,
I would just add that to an objection to your illiquidity would be that, yes, though you are right in the sense of removing part of the investor's emotional aspect, it also enhances over time because I don't know about you, when you've reached 5 years, 6 years, 7 years, and these guys haven't started liquidating, they're like, hey, where's my principal? When am I going to be getting my money back?
That's where we come in and we do the proper job to find these investments that do not do that.
Well, and that's also part of that diversification factor that shouldn't be an issue if somebody's not overly invested in any one particular thing. So I think that's the big factor for everybody is you got to do your own due diligence. You got to be comfortable with what risks you're willing to take or not. I think that's the hardest for a lot of people is they don't really know what risk is, and that's where our jobs come in is to help give people the right guidance.
Well, and letting them know that, you have a time frame of the investment, but they're looking out for the investor's best interest too. So, I mean, if we have a downturn in the economy or a downturn in that industry, obviously they would rather wait it out to be able to get good price appreciation than fire sale the assets just to hit their time frame mark. So that's where, spreading out multiple alternatives inside your portion are going to allow those to kind of liquidate one by one over time.
There again, any investment that has multiple year time frame, you should not be putting money in that you're going to need it back out because the surest way to create a loss is to get sold, is to be forced into selling at a bad time.
Yep.
And we've seen that in my 25 years of doing this. There's been multiple times I've seen investments that people sold on one day that if they would have waited 2-3 years later, they would have been selling at a much better price. So a lot of it's just circumstantial and making sure that you don't get put in those bad circumstances.
Well, Go ahead.
Oh, one last thing that I think is probably really important when it comes to alternatives, and just being around some of the ones I've seen over the last 5, 6, 7 years now, is doing your due diligence on the guy or the person who's running it, the operator.
Sure.
Are they going to be able to hit their benchmarks and hit certain things and their goals? Because there's been a lot of cases where you get a lot of guys that will come out and give you a whole bunch of fluff, and that they're going to take care of all of these things and do all of these things, and then it just turns out that the operation, the investment itself was not a bad investment. The operator can be a problem.
Yeah, I mean, you say that, and that's great. I love. You're absolutely dead right. But the problem is that I see in that is that everyday average Joe that comes in and sits down at his broker's office or whatever, he doesn't know shit. He doesn't know how long that. I mean, like, okay, sure. I've been around 25 years. I've been to enough conferences over the last 25 years to see what guys are there every single year. So yeah, I can identify the people that are like, hey, you know what? They've been doing the same business, the same way, in the same place for decades. Okay, I trust that guy. I'll work with him, right? Because he's done the same thing in the same place for the same. That's a business person I want to deal with. So I just think as a consumer, that's where your advisor comes into the factor.
Yes.
Is that experience matters, because the only way that you know that one of these alternative investments or a stock or a bond, any investment whatsoever, is if the operators have been doing the same thing in the same place for a long period of time. If you find that, okay, then you know you're probably gonna make me a little more of a fan.
Well, and that's why I bash these crowdfunding alternatives,
there
all
you
the
go.
time,
Yeah.
because that's just it's one, they get away with, offering the moon, and they don't deliver anything. But two, you don't know their track record. They're just Joe Blow coming into the space because they see a run up in apartment buildings, so they're like, I want to get into it, and it's been proven that doesn't work.
You know what happens to people in a crowd? They get ran over. They get trampled. Right? Being in the crowd is not the way to invest. Right? That's
true.
Let's to keep it that way.
Watch a Walmart video on Black Friday.
Yeah, bad Walmart crew. All right. So let's wrap this up, because essentially, alternative investments, guys, as we covered, it's anything that's not correlated to the stock or the bond market. It's not in public markets. So it could be real estate, it could be loans, it could be hedge funds, it could be private equity, it could be investment banking, where you're investing in private enterprises at an early stage. The risks, a lot of these things are illiquid, so you definitely don't want to put all your money into one place. You need to find ways to diversify it, just like you do with all investments. But the advantages are really that you can balance out a portfolio, is basically what you guys were saying, is that you can take a portfolio that is normally correlating up and down with the stock and bond market, and maybe create some anchors in times when those performances of the stock and bond market aren't so great. So you can reduce correlation, you can increase income, things of that nature. So I think with that, it's worthwhile for people to investigate more. And it's been a long time. It's been a really long time since investors have had to think about investments other than the stock and bond market as a way to create wealth. In fact, most investors today, they were just pure glimmers in their parents' eyes, right? When the last time that we had a bear market or we had inflation. I mean, the last time people had to deal with inflation was the 70s, really. I mean, so like most people investing today haven't really had to deal with that. Luckily, we have. We've been there. We've gone through this. And optimizing a portfolio is really all about making sure that you can maximize what's going on in the market cycles. And so if alternatives is another way that you can do that while markets are rough, it's worth checking out. So if you're interested in knowing whether alternative investments are right for your portfolio, then visit the quiverfinancial.com website and set up a conversation with us, and we'll be happy to tell you everything that we know.